Well, how's it going? And welcome back to How to Invest in Commercial Real Estate. And we have a super exciting guest on today. I'm excited to get into. I always love talking about multifamily deals. It's super interesting. And we're retail guys, so it always is fun to get into multifamily. Anyway, before we get into the guests, just a quick update. We do have some deals we are fundraising right now. We have the Grand Rapids deal up on the website that we are fundraising for. Super excited about that deal. I think we're targeting 18.5 IRR, like 9% cash on cash the first year.
Yeah, a little over 9.
A little over 9. So again, super excited about that deal. It is fundraising right now, closing on that December 17th, I think. Anyway, a couple weeks into it.
And I think we've got 2 other deals, one here in Oklahoma, one in Chicago. It looks like both are probably going to close first quarter next year because it's getting late. So keep an eye out for those. Yeah, what else we got?
Yeah, both shopping center deals. Exciting. We've been on a roll. There's been like 3 or 4 in a row. Anyway, excited to get back into that. So we won't delay any further. We'll get right into the guests. Today we have Zihao Wang, which is the founder and CEO of Motiva Holdings, which is an LA-based, I believe, family office focusing on multifamily investments. Again, super exciting. Zihao, tell us a little bit about yourself and how you got into this, and then we'll go from there.
For sure. Thank you so much for having me.
Yeah.
Started in the real estate industry through the family. So family originally made their money in the fashion industry back in the 80s, and then came to the US in the early 2000s to continue that fashion brand. And then it was also the time when, my parents set up the family office and then started investing into real estate locally in Southern California, where we're based. Got into it in 2016 on the property management side for 2 years, managing our family's assets before moving on to the acquisitions and capital markets side, and trying to expand kind of what the family had internally. And right now we're around $500 million worth of assets across 34 projects in 3 states, primarily invested in Southern California multifamily. Around 2/3 of our holdings is here. And then we're also in North Carolina and Florida.
Nice. Wow. So in 2016, this is you personally. Your family was in it before, and was that before college or after college or?
No, it was before college. So I kind of started as, a middle school student-ish, kind of riding along the wave with my parents, kind of following the footsteps of my parents and doing everything, kind of shadowing everything they were doing, from, site tours, from underwriting, from talking with brokers, seeing deals come through, exiting deals, etc. So that was kind of my lead into the real estate world through the parents. And then now I kind of run the day-to-day activities. So they still sit on the investment committee and make the major decisions. But the day-to-day operations and day-to-day decision-making is now handled by me.
Nice. So you knew a lot about about real estate before you even went to college. Is that right?
Yeah. I kind of grew up in a very real estate-oriented family. I actually knew more about real estate than about the fashion business, which, is actually their operating business. Much more exciting seeing properties than seeing clothes,
Yeah.
So interesting that you chose to go into computer science and finance, I believe. Is that right? Did you feel like that was something that would help you in the real estate?
I felt it would help me on the, underwriting side of things. But I think the major reason why I chose CS is I think 75% of people at MIT major in CS. So it'd be kind of awkward for somebody to, not major in CS in some way or form. There are a lot of different majors under the CS umbrella at MIT. I was just kind of trying to kind of fit in a sense. So chose CS as my major. But yeah, it definitely helps on the underwriting side of things, gets you very used to seeing a lot of numbers, seeing a lot of how different numbers move, how like changes work and stuff like that. So I would say it's still in a sense slightly connected to what I'm doing today.
Nice.
Does your family manage themselves, or do you guys hire third-party management companies?
We started with third party when we were much smaller, but at around like 500 units, we decided to bring everything in-house. So now in Southern California, we own our own property management company and run everything basically in-house. For out-of-state assets, though, we're still not at the scale of doing everything ourselves. So we're still with third-party management.
Yeah, that makes sense.
Yeah. So I assume Motiva Holdings has grown maybe since you graduated from college and went back to doing this full time. How have you scaled the company and brought in? You have, I believe, $500 million under management. Is that right?
Yeah, so $500 million total managed. So we've exited some portfolios in and out. So right now, like our active, so we've been kind of a little bit on the sidelines since 2020, late 2021 and 2022. So a lot of our assets are already kind of exited and went full cycle. But yeah, in terms of scaling, we definitely look to bigger assets. We started off with 7-unit properties and then 16-unit properties. And then now we're kind of our most recent acquisition was 90 units, 20 million in Southern California. And then some of our out-of-state deals are around 250 to 350 units. So in terms of like property size, we definitely scaled up. And then also the number of properties, we were pretty active kind of in the 2018, 2019 kind of days.
So you're on the sidelines a bit since 2021, 2022. What led to that decision?
We just felt the market was super volatile. We didn't really know where we're going to go in terms of like interest rates and price expectations. So that we didn't want to kind of expose ourselves to that kind of volatility and market risk in the real estate asset class, right? So we decided to stay a little bit more on the sidelines, kind of check everything out before going back in. We're actually a lot more aggressive now, kind of tailing 2024 and heading into 2025. We're just trying to our advantage is really having a lot of dry powder and be able to close deals fast. So we're trying to find those opportunities that might be, like a distressed seller or, like a end of fund life kind of deal and trying to get some of those.
Yeah, go ahead.
Well, it's interesting because I have another company outside of Criterion, and we do own some multifamily, and we kind of took a similar path. COVID, I felt like that interest rates were going up pre-COVID, and they kind of never did. And then we hit COVID, and then they came down even further, and cap rates were just hitting the floor lower than we'd ever seen them. And so yeah, we just kind of said, hey, we don't want to be buying these deals that at 3.5, 4 cap when they're getting debt at 2.5%, because if debt changes, those valuations are going to be tough to sustain. So. But we are kind of getting back into the market now as we see cap rates have kind of elevated, rates have plateaued, and so we think it's a good time to try to start moving back into the market. Is that kind of what you guys feel?
Yeah, we feel like, I think it was like, at least on the multifamily side, a lot of markets were overbuilt, and there was a lot of uncertainty as to what that rate of absorption would be and kind of what rent growth would be. And also like pricing when the so-called distress that people have been talking about for like 2 years now, when that's coming and stuff like that. So we're kind of just still checking out the market and finding ways to get back in, knowing that, kind of construction is pretty much stopped. The pipeline is much, much less than it was during the pandemic. So we feel much more comfortable and a little bit more transparent on the market right now.
Yeah. Since you brought up rent growth, what sort of rent growth do you all see on your Southern California assets? I know, it's super regulated. I believe there's rent control in California. So
some areas, yeah.
In some areas. So, why do you guys love California? I know you're in North Carolina and Florida, and you obviously see different pricing out there than you would, around you all in Southern California. So why do you like Southern California, I guess is the main part of the question. And then what sort of rent growth do you see just generally on your assets out there?
So in terms of like rent control and stuff, it depends on the location. City of LA is like 3 to 4%. Pasadena is like 3%. Santa Ana is like 3%. But there are other pockets where it's like at the state level rent control, which is 5% plus CPI. So it was like 8.9% this year. So we can like depending on the kind of asset, we can actually push rents to that 8.9 if it was like a long-term owner with a lot of loss to lease there, like maybe like a $500 loss to lease. So we can just push 8.9, 8.9, 8.9. And then or other assets where it's like, the rents are already at market. So then it becomes really kind of inflation driven and market driven. Then we're probably seeing somewhere at like 3%, which is kind of average of what we're underwriting on kind of all across Southern California. The reason why we like SoCal so much is because we're local. A lot of people are really afraid of this market because of the regulations and stuff, but I think that's partially driven because of the fact that they don't actually live here and they don't like own so many assets here. By us being local and know kind of the city council members and stuff like that, we have a much better pulse as to what's going to happen in terms of legislation. And I just feel we manage better when we're as close as possible to the assets.
Yeah. Okay.
Yeah, and I think it'd be interesting for me, just coming from Oklahoma, and the market is totally different. Although I have purchased multifamily assets in other states, nothing's quite like California and New York and others. So I got the rent growth question, but talk to us about what is the cap rate at the going in cash on cash numbers and properties if you're going to try to buy a property in California today, and is the main driver rent growth, or can you get to a day one cash on cash that makes sense?
The main the main return driver would be turnover, to be honest, because at least for our strategy, we try to target kind of long-term owners who haven't raised rents for a long time, and because of rent control, you'll never actually hit the market. So for example, our most recent deal in Downey in July was a $20 million deal. Essentially, I think it was like a third generation owner, and the parents just passed away, and then now it's falling into like the fourth generation, and they just want to sell the asset. And so there's been one, like they never raised rents for a very, very long time. So the units are kind of at $1,500 in rent when market is like 22. So then there's that like gap of loss to lease. Because of rent control, though, we can't actually get to that like 2,200 the next day. We have to kind of either prey on turnover where tenants move out and we can renovate and go straight to market, or we hit them with the annual rent increases at which the state allows, which 8.9% this year. So I would say for our strategy, we underwrite to kind of the rent growth projections of what the state allows us to do. And we know that even if we increase it at like an 8.9%, tenants probably still won't leave because it's still below market because of the rent control. And so we underwrite to that, and kind of the cherry on top is if tenants decide to leave the property for another one, then we can go right into renovating that property, renovating that unit, and go right up to the 2,200.
So what would the going in place cap rate be on a deal like that, where you have so many tenants under market and there's that upside down the road?
So this specific property was at a 5.5 cap rate, which is actually decently high.
Yeah, it sounds, for California, sounds high. Yeah.
Yeah, most properties like that will probably trade between the 3-ish cap rates. So like the kind of the 2 to 3-ish, between high 2 to high 3 cap rates typically. But this one we got it off market. The seller was hoping for a quick close, and that's kind of where our advantage comes in. So we were able to get that one at 5.5. The business plan pushes it to 7, and we exit back at 5.5. Yeah,
that's great. And then I'm assuming a lot of these deals then are being acquired all cash.
It depends. We've definitely we did 4 deals this year. We did 2 of them that were all cash, and then 2 of them we had we had loans on them.
Yeah, maybe the 5.5 cap you can maybe put some debt on, but like if you're buying, I mean not you, but other people buying a 3.5 cap deal, I mean maybe back after COVID, you might have been able to put some debt on it, but today you'd be kind of severely underwater with your debt rates.
Yeah, you'd have to go interest only.
Still,
yeah, even then it may not work.
Now, when you guys do use debt, are you agency debt guys, or are you getting some other kind of debt?
We like to do a lot of bank financing. We have really good relationships with the local banks, partially because we have a lot of deposits with them from the operating fashion business that's still going on. So the banks typically like to give us really good rates and a lot of proceeds to do loans with them.
So, what's your forecast and strategy, your goals for the next 5 years or so? What if I had to ask you to sum up your goals for the next 5 years? What is it? What are you going after? How big are you wanting to get? How many assets you want to acquire?
We try to acquire around 5 assets a year, typically. We haven't hit that mark for the last 3 years. So we did 4 this year, and then we were very quiet kind of in the years prior. But I'm hoping like 2025, 2026, we can get a little bit more aggressive and acquire around 5 assets a year. And I do believe kind of like from a long-term growth perspective, we're kind of in correction mode for multifamily right now. But like 5 years later, I'm more optimistic as to the environment of multifamily. So, hopefully in 5 years, we can cycle some deals out from our current portfolio as well.
And then a couple other questions here, and then we'll wrap it up. I'm curious, are you guys all your own equity, or do you guys syndicate or partner at all?
Very, very few partners. We primarily do kind of just the family stuff. We have brought in like ultra high net worth individuals that were kind of friends and family, as well as some other family offices to partner on deals. But typically we're the anchor LPs, and we like to kind of control the deal and then put majority of our capital into it.
And then let's say you are gonna co-GP or partner with somebody. What are your IRR expectations or goals? What are you guys trying to get year over year?
We typically aim for an 18 plus IRR, and that's even without partners. We still try to do that ourselves. So at the deal level, we need to hit like somewhere around an 18.
Mm-hmm, mm-hmm. That makes sense.
Typically, what we're years ago we were hitting over 20 pretty routinely, but now most of the deals are with the debt where it is and the cap rates where they are. We're penciling 18 to 20.
Yeah, and that was to the LP. So that was post split. I mean, deal level, it was well over the 20.
Yeah, we're trying to hit 18 for our partners.
Yeah.
And we typically are doing a 8 pref and a 70-30 split to the investor.
Yeah.
So kind of our standard anyway. Well, do we have any other questions?
That's all I had.
Man, super excited for you. That's an awesome business to step into, and it sounds like you're running it really, really well. Would love to stay in touch, but if we want to be able to plug you, and so is there a website we could send our listeners to that want to check out what you're doing? Tell us.
Yeah, I mean, we have our website, motivaholdings.com, but I'm also very active on LinkedIn. So happy to connect there as well.
Nice. Nice. Well, congrats on the family success. We wish it continues for you. And if we ever get involved in a property out in California, we'll definitely call you and get some advice.
Awesome. Thank you so much for having me, guys.
All right, guys.
All right.
Thanks. And we will
Thanks,
see you
Zihao.
next time on How to Invest in Commercial Real Estate. Thanks, everybody.
Thanks.